Welcome to our channel, where we dive deep into the world of cryptocurrency, uncovering the hidden dangers and providing you with the knowledge you need to protect your investments. In today's episode, we'll explore the red flags of crypto scams and equip you with the tools to stay safe in this digital frontier. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. 1. Too good to be true promises. Too good to be true promises are one of the most common red flags indicating a potential crypto scam. In the world of investments, particularly in cryptocurrencies, the old adage, if it sounds too good to be true, it probably is, holds significant weight. Scammers often lure unsuspecting individuals with promises of astronomical returns on their investments, while downplaying or completely ignoring associated risks. These promises can take many forms, such as offers of guaranteed daily profits, incredibly high interest rates, or the assurance of risk-free investments. The intent behind such claims is to create a sense of urgency and FOMO, fear of missing out, in potential investors, pushing them to act quickly without conducting proper due diligence. In reality, legitimate investments carry inherent risks, and while significant profits are possible, they come with a commensurate level of risk. Investors should be highly skeptical of any opportunity that promises extraordinary returns without providing a clear and transparent explanation of how those returns are generated. 2. Unsolicited offers. Unsolicited offers are another red flag that crypto investors should be wary of when navigating the digital investment landscape. These offers typically involve receiving unexpected communication, often via email, social media messages, or even phone calls, from individuals or entities promising incredible investment opportunities. These unsolicited offers can come from seemingly reputable sources or individuals who claim to have insider information, making them appear legitimate at first glance. However, they are frequently part of scam tactics designed to exploit the investor's curiosity and lack of familiarity with the cryptocurrency market. In many cases, these unsolicited offers may pressure investors into making quick decisions, often without providing sufficient information or allowing for proper due diligence. 3. Lack of regulation. The lack of regulation in the cryptocurrency space is a significant concern for investors and a potential red flag to watch for. Unlike traditional financial markets that are subject to stringent regulatory oversight, the crypto market operates in a largely decentralized and unregulated manner. While this decentralization is one of the key principles of cryptocurrencies, it also creates an environment where bad actors can thrive. Without clear regulations and oversight, there is a higher risk of fraudulent schemes, scams, and market manipulation. Investors should be cautious when dealing with cryptocurrencies and projects that operate in jurisdictions with minimal or no regulatory frameworks. The absence of regulation means that there is limited recourse for investors if something goes wrong, such as the loss of funds due to hacking, fraudulent schemes, or mismanagement by crypto exchanges or projects. 4. Anonymous teams. The involvement of anonymous teams in cryptocurrency projects is a red flag that investors should be cautious of when considering an investment. While anonymity itself isn't necessarily a sign of fraudulent intent, it does raise concerns about transparency and accountability. In the crypto space, some projects are developed and operated by individuals or groups who conceal their identities, making it challenging for investors to verify the qualifications, intentions, or track record of those behind the project. This lack of transparency can make it difficult to assess the credibility and legitimacy of the project, leaving investors vulnerable to potential scams or mismanagement. Investors should exercise due diligence and approach projects with anonymous teams with extra caution. 5. Pressure to act quickly. The pressure to act quickly is a common tactic used by scammers in the cryptocurrency space to manipulate investors into making impulsive decisions. This red flag often involves creating a sense of urgency or fear of missing out, FOMO, to push individuals into making immediate investments. Scammers may use tactics such as time-limited offers, limited availability of tokens, or false claims of imminent price spikes to pressure investors into buying or transferring funds hastily. Investors should always be wary of any investment opportunity that pressures them to make quick decisions without adequate time for research and due diligence. Legitimate investments allow individuals the time to thoroughly investigate the opportunity, understand the risks involved, and make informed choices. 6. Ponzi or pyramid schemes. Ponzi and pyramid schemes are fraudulent investment schemes that promise high returns to investors but rely on continuously recruiting new participants to pay returns to earlier investors. In a Ponzi scheme, the operator typically claims to invest the participants' money in legitimate businesses or investments, but actually uses the funds from new investors to pay returns to earlier participants. This creates the illusion of profitable investments and encourages more people to invest. As long as new participants keep joining and contributing funds, the scheme can appear to be successful. However, it eventually collapses when there are not enough new investors to pay returns to earlier participants, causing substantial losses for those involved. 7. Unusual wallet addresses. Unusual wallet addresses can be a significant red flag when it comes to cryptocurrency investments. Wallet addresses are typically a string of alphanumeric characters that serve as a unique identifier for cryptocurrency transactions. In some cases, scammers may use unusual or suspicious wallet addresses to obfuscate their activities and make it difficult for investors to trace where their funds are going. Unusual addresses may contain irregular characters, have extra long or extra short lengths, or exhibit patterns that are inconsistent with standard wallet addresses. These can be indicative of fraudulent schemes or phishing attempts where scammers are trying to deceive individuals into sending their cryptocurrency to a fake or unauthorized address. Investors should exercise extreme caution when encountering unusual wallet addresses, especially in unsolicited messages or suspicious investment opportunities. It's essential to verify the legitimacy of any wallet address before sending cryptocurrency, especially for larger transactions. 8. Fake social proof. Fake social proof is a deceptive tactic often used by scammers to create an illusion of trust and legitimacy around their cryptocurrency schemes. Social proof involves showing evidence that others have successfully invested in or benefited from a particular opportunity, thereby encouraging new investors to follow suit. However, scammers may fabricate this social proof by using fake testimonials, reviews, or endorsements. They might create counterfeit social media profiles, forge positive comments on forums and websites, or even pay individuals to vouch for their fraudulent offerings. This false social proof can mislead potential investors into believing that the opportunity is genuine and reputable. Investors should be highly cautious of any cryptocurrency investment that relies heavily on social proof without providing verifiable evidence of its legitimacy. 9. No clear use case. A red flag for potential cryptocurrency scams is the absence of a clear use case or utility for the digital asset being promoted. In the world of legitimate cryptocurrencies, projects typically have a well-defined purpose or function within their ecosystem. For example, Bitcoin serves as a decentralized digital currency, while Ethereum facilitates smart contracts and decentralized applications. When a cryptocurrency lacks a clear use case, it raises concerns about its value and legitimacy. Scammers often create cryptocurrencies without any genuine utility, intending to lure unsuspecting investors with the promise of massive returns. These fraudulent projects may use elaborate marketing tactics and hype to generate interest, but lack any sustainable long-term purpose. 10. Lack of information. Lack of information is a critical red flag when it comes to identifying potential cryptocurrency scams. In the world of cryptocurrencies, transparency is paramount. Many legitimate projects provide detailed information about their technology, team members, use cases, and development progress. However, scam projects often lack this transparency, making it difficult for investors to assess their legitimacy. One common manifestation of this red flag is when a cryptocurrency project doesn't have a clear white paper or provides one with vague or copied content. A white paper should outline the project's goals, technical details, and implementation plan. Legitimate projects are usually eager to share this information with potential investors. Additionally, a lack of information about the project's team members or advisors can be concerning. Investors should be able to verify the credentials and backgrounds of the people involved in a project to assess their competence and trustworthiness. Thanks for joining us on this journey through the world of cryptocurrency scams. Remember to like, subscribe, and hit that notification bell to stay informed about the latest crypto insights and security tips. Stay safe out there, and we'll see you in the next video.